Sanjay, great to have you here with us. So Orkla started in India with MTR in 2007, and then you acquired a controlling stake in Eastern Condiments.
Yeah.
Tell us a bit about the journey and the size of the company, the revenue growth and margin so far.
I think we Orkla entered India in 2007, as you know, through the acquisition of MTR. Our journey in India has been a quick study of the regional preferences and a deep understanding of the consumers, which led to the purchase of MTR as a company. Now, we are unlike any other multinational. We are, we don't look at India as a single country. Of course, it's a single country, but we look at it as a collection of 28 markets. And as a result of which, I think our focus has been to build regionally dominant brands. And as we progressed in our journey, I think what we did, we acquired Eastern, which was also a great acquisition because it helped us move from one state to another state and helped us acquire a very strong heritage brand in the state of Kerala, which talks to a very different cuisine than what MTR talks to.
So what's the breakup between spices and condiments? Which are the two areas you're present in?
So spices, we have two categories, spices and convenience food.
Convenience food.
Spices, as you know, is the core of Indian food. Without spice, there is no food. Spices contributes roughly 66% of our business, and the rest is convenience food, part of our business.
And if I look at the revenues, Sanjay, it's not been growing very fast. It's about a 5% CAGR. Do you see that? What explains that? Because it appears that the packaged food industry as a category grew faster than you. So were you underperforming? If yes, if you could tell us the reasons. And do you see this changing?
I'm not sure about how things have moved. I think our current performance is a reflection of, our short-term performance is a reflection of macroeconomic impacts that are there. And I think you know it better than I do. When you look at what's happened in the last 2-3 years, you've seen FMCG slowdown happening, you've seen consumption squeeze happening, you've seen inflation go up, led by food inflation, which has got back. But if you really step back and look at what has been our journey so far, when we had just MTR between 2010 and 2020, we had grown at about 13%. Then we did the Eastern acquisition in 2021. That was the COVID period. So you look at after COVID, 22-24, we've again grown at 13.2%. So I think economic cycles come in and go out. I think you should look at what is the volume development in the company. And when you look at our quarter one numbers in the RHP, you clearly see that we are continuing to build the business very strongly with about 8.5% volume growth that has come through. Price growths will keep happening because inflation keeps fluctuating in the country. And we have strong brands in our portfolio which help us manage inflation. So in an inflationary scenario, our brands are strong enough to pass on the increase, and in a deflationary scenario, we are strong enough to manage the deflation.
So this volume growth of 8.5% in Q1, do you see that sustainable? Do you see moving up to double digit?
I think you can see that the government in the short term has taken a lot of actions this year. You've seen income tax reducing. You've seen interest rate comes down for consumers. You've seen GST reductions that have hit now. All of this is stimulating the economy. And if you look at the first quarter, now the latest quarter FMCG results which are coming out, they're all pointing upwards.
Okay.
You look at our quarter one numbers relative to the earlier quarter numbers or the FY
there is
numbers,
a pickup.
There is a pickup. So we do see that we are moving in the right direction. And secondly, I think from a long-term perspective, if you look at it, I think the Indian economy is continuing to grow well. The per capita incomes are developing. There is going to be a shift from unorganized sector to the organized sector. Spices still 60% of the industry is in the unorganized sector. So we will still continue to grow that percentage, driving per capita sales up for the business. On the other hand, you've seen the India A consumers or the millennials and the Gen Zs which have come in, which have much lower levels of knowledge in cooking. They are starting to buy the convenience foods triggered by the e-commerce, the quick commerce development which is happening. So we do see that there is a huge opportunity to grow in the long term, and I think we are on the right path, and we have the right company to drive that growth.
And you're also on the right path when it comes to margins.
Yes.
You've the margin improvement trajectory is very impressive, and you now stand at 18.7%. What drove the margin expansion? If you could give us a couple of reasons. And, are these margins sustainable, or do you see it even crossing 20%?
I think, we talked about food inflation and how it, or deflation in spices and how it hit our top line revenue growth. So we did see a slowdown in that. But on the other hand, our margins have expanded. So our margins have expanded at the back, I think 50% at the back of raw material price decrease. And 50% is at the back of many inside initiatives that we have taken in terms of driving, operational efficiencies up, whether it is a shift towards the sale of value-added products, whether it is outsourcing from low value-added production, whether it is digitalization that we are doing, whether it is the manufacturing rationalization programs that we have put in, and obviously the everyday black belt or cost improvement programs that we run in the company. So all of these have actually also contributed to the margin expansion. So we are on a good trajectory as far as margins is concerned.
Yes, no. Do you think margins sustain at these levels or expand?
See, I can't give futuristic oriented statements at this point of time. But I think we are in a good place. I think we've got great programs going. If you want to normalize our margins, you can take half the margin improvement and reduce it. And I think that's the right level for us to continue to build it from.
Got that. You made it very clear that, you all are different from the other MNC players who have this one objective that we're a pan-India player. Yeah. But you want to go deeper. You see yourself as a regional player, and you want to go deeper and provide more value, which also shows up in the way your revenue breakup is 70% from the south. Right. So take us through that strategy, and also on the international side, which is now 20% of your overall revenues.
Yeah. So let me first talk about the domestic side of the business. I think most people look at India as one country, and we've done a lot of investor meetings. Everyone talks about pan-India. To me, in foods, I think there is nothing known as pan-India. I think food is regional. You are from Maharashtra. You don't eat South Indian food every day, do you? Right? So I am from Punjab. I am running a South Indian company. So I think somewhere you have to understand that food is local. Okay? And in the four South Indian states, they are not one homogeneous mass. They are different cultures. The Tamil culture is different from the Karnataka culture, which is different from the Kerala culture, different cuisines, right? And I think food is local, brands are local, and therefore the business of food is local.
Okay.
So there is, in our minds, I think we are building our business with that philosophy in mind. And it's not that we are not available all India. I'm available in Delhi, I'm available in Ladakh, I'm available in northeast of India, I'm available in Gujarat. We are available everywhere, but we are not the local food for those people. So we are the local food of Karnataka, we are the local food of Andhra and Telangana, and we are the local food of Kerala, and that is why our 70% of our revenue is set out there.
Okay, we are out of time, so I want you to quickly explain why is your capacity utilization low at 46%, and tell us about the balance sheet, because you're not doing a fresh raise, which goes in money going into the company. So very quickly explain these 2 points.
On capacity utilization, I can tell you that when we did the Eastern acquisition, we had 4 factories in MTR, 7 in Eastern, and we had the average of that utilization ended up with 9 factories and 46% capacity utilization. I don't think that's a problem. It's a legacy that we have acquired. I think going ahead, we are the way to look at it is that we don't need any fresh capex, because capacities are pretty fungible in nature. So we don't need any fresh capex going ahead. In terms of why did we do OFS and not a primary issue, I think we are a cash generating company. We are generating 300 to 400 crores. So we have enough of capital available in the books. Our balance sheet is strong. We don't have any debt. So if you need to raise any money, you can do that very easily. And that is what is the reason. I think if we have to access the capital market after that, I think the only way to do it is really to do an OFS. And by doing the OFS, I think Orkla, which is the promoter company in this case, will come down and meet the MPS norms of 75%.
Sanjay, I have so many more questions. It's such a fascinating industry, but really out of time. So thank you very much for joining us today on the show. Thank you.
Thank you, Reema.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
Thank you for watching CNBC TV18. For all our top stories and news updates, follow us on